Smart Success presents 10 Warning Signs of a Stock Market Crash. From 2009 to 2020, the world's longest bull market lasted until COVID-19 swept the globe, sending stock prices plummeting. While economic conditions deteriorated for a while, the bear market only lasted a few months before the bulls reclaimed power. The markets could conceivably still be in the midst of the longest bull run in history if it weren't for the coronavirus. That's both thrilling and terrifying. The market is a cyclical beast, according to history, but when its ebbs and flows are out of balance, significant corrections occur. A huge dilemma arises with share prices reaching historic highs, despite economic difficulties and rising debt loads, an important value criteria advising investors to flee. It's critical to pay attention to the warning indicators that the market almost cries at enthusiastic investors who often refuse to listen in order to evaluate whether you're about to enter a slump. In reality, the excitement of large returns is frequently what drives investors down the incorrect path, resulting in market disasters. But, exactly, what are those red flags? Do they have a good track record of predicting a crash? Let's take a look. Number 10. Corporate profits turning flat. Profit is one of the most important factors in the stock market, and for good reason. No one wants to invest in a firm that is losing money and shows no signs of turning a profit. Investors are thrilled when earnings are increasing and are eager to put more money into the stock. The price-to-earnings ratio, also known as the price-to-profits ratio, is a crucial measure used by value investors to determine whether a stock is undervalued or overvalued. In other words, a company's profits aid in determining the stock's fair value. When earnings begin to flatten, it's a sure warning that a market crash is on the way. Number 9. The Buffett indicator. The Buffett indicator is a basic metric for determining whether the stock market as a whole is undervalued or overvalued. Warren Buffett, the legendary investor, introduced it initially in 2001. Economists and Wall Street professionals have utilized the indicator nearly obsessively since then. The indicator relates the total value of the stock market in the United States to the country's gross domestic product, GDP. According to Buffett, the market is reasonably valued when the indicator is between 75% and 90%. When the indicator reaches 90% to 115%, the market is considered somewhat overvalued. Finally, if the indicator exceeds 115%, the market is significantly overvalued and on the verge of a major correction. According to current market valuation, the indicator was over 239% as of September 29, 2021, indicating that the market is extremely overvalued and that major drops are likely ahead. Number 8. Rising inflation. Inflation is unavoidable. A moderate and steady increase in pricing for consumer products, services, and any other category is usual as the economy grows. It's why your great-grandparents could buy a whole lunch for a penny, whereas today a stick of bubble gum costs that much. When inflation occurs too quickly, it creates a concern. The Federal Reserve of the United States has set a target of 2% inflation, which it believes is a reasonable rate of price increases. Rapid inflation is common in the run-up to market crashes. This creates a significant issue. Consumers become more fiscally concerned as prices rise, which frequently leads to an increase in saving activities and a reduction in overall spending. Reduced corporate profitability is on the horizon after that, which could result in a stock market meltdown. Number 7. An extended bull market. The market is supposed to be a well-balanced system, but in reality, it is far from that. The stock market battles to keep valuations in check from day to day, month to month, and even year to year as bears and bulls dispute their positions. When the bulls have too much control for too long, the prices investors pay to own shares skyrocket, resulting in severe overvaluation. On the other hand, too much bearish control causes stock prices to plummet, resulting in extreme undervaluation. In fact, active traders make it their life's work to profit from the market's erratic equilibrium. Take a look at how long the market has been trending upward. The average bull market lasts roughly 2 years and 7 months, according to Forbes. A bullish streak that lasts far longer than usual could indicate that we're due for a reversal. Coming in at number 6. Domestic and geopolitical uncertainty. Politics will always play a significant effect in the stock market. Whether political changes occur at home or throughout the world, legislative changes have the capacity to pick up or entirely destroy huge segments of the economy. Prior to market crashes, political instability is a prevalent concern. After all, when investors are unsure of what to expect, they are less willing to risk their money, resulting in decreased investor interest and market value declines. Political uncertainty in the United States was high during the 2020 election season and has remained a problem since then. Concerns that President Joe Biden could hike corporation tax rates from 21% to 28% have arisen as a result of expectations that the political environment will be unfavorable to investors. Since the first tax increases were expected, a few new ideas have surfaced. Biden has proposed raising the minimum business tax rate to 15%, and lawmakers have recently proposed boosting the corporation tax rate to 26.5%. Despite the fact that no one knows where the rate will wind up, an increase in corporation taxes is all but certain, which could reduce profitability and contribute to market falls. Many say that geopolitical uncertainty will persist for some time to come on the world scene, as China, Russia, and Iran fight for power, and many Western countries confront internal political turbulence. Uncertainty or large political events could have a significant impact on the market. Number 5. Excessive emotions. Emotion is a major factor in stock market movement. When fear strikes, market prices fall as investors sell their holdings, and when exhilaration and greed strike, market prices soar as investors buy shares. Emotions can run high in some circumstances, leading investors to disregard all fundamental analysis and make emotionally driven judgments that lead to excessive undervaluation or overvaluation of stocks. When the market becomes overly enthusiastic and overvaluations become rampant, a crash is imminent. The Fear and Greed Index is one of the finest techniques to determine this. The index was created by CNN Money to determine if investors are overly bullish or bearish based on the two basic emotions that drive the market. The indicator stood at 34 in September, indicating that investors are concerned about the market, with the market turning apprehensive after a long period of greed and sentiment dwindling. Further drops may be on the way. Number 4. An inverted yield curve. When long-term coupon rates on fixed income instruments fall below short-term rates, the yield curve inverts. Because long-term fixed income investments often yield a higher return than their short-term counterparts, this activity is referred to as inverted. When the curve is inverted, investors assume that economic difficulties are on the way, and that interest rates will fall in the long run. This has historically been a strong indicator of impending crashes. In fact, an inverted curve has occurred right before each recession over the last 50 years, with just one inverted curve occurring but not being followed by a recession. The yield curve has been rapidly moving upward thus far in 2021. However, in recent months, the curve's expansion has slowed, and a flattening tendency may be on the way. Number 3. Declining vehicle sales. Vehicle sales are a good indicator of the state of the economy in the United States. As a result, they might be a good indicator of a potential stock market meltdown. The purchase of a new automobile is a major investment with a hefty price tag. The majority of people need loans to purchase vehicles because they simply cannot afford to pay cash for them. As a result, vehicle sales tend to be positive when customers believe that better economic times are on the way, but they seem to hit a brick wall when mood turns negative. You may get a sense of how customers feel about the economy and their willingness to make large-ticket purchases by looking at automobile sales trends. This is significant because customer attitudes toward the economy often influence their buying and saving patterns, resulting in either revenue growth or reductions for many businesses. Vehicle sales in August were down more than 13% year-over-year, according to Forbes. While some speculate that this portends a market catastrophe, others point out that a recent semiconductor shortage has prompted manufacturers to cut new vehicle manufacturing, which has contributed to the reductions. Number 2. Declining home sales. The motivation for tracking home sales is similar. People are less likely to buy a home if they are concerned about the status of the economy. Existing house sales are now on the upswing, with the National Association of Realtors reporting a 2% gain in July. If sales continue to rise, it will be a clear indication that consumers are optimistic about future economic growth. Coming in at number 1. Prolonged dovish monetary policy. The Federal Reserve Bank of the United States, usually known as the Fed, is the country's central bank, which means it is in charge of the country's monetary policy. The Fed has a significant influence in market activity since the stock market is, at its heart, a mechanism that allows for the movement and balance of cash and value. When the Fed determines that the U.S. economy is in difficulty, it implements one of two essential policy measures, or a mixture of both. The Fed funds rate is the rate at which banks charge each other for lending excess cash overnight. When this rate falls, interest rates on loans such as mortgages, auto loans, credit cards, and other types of loans fall as well, resulting in a flood of lending. Of course, when individuals can borrow more money for a lower cost, they do so, resulting in a flood of liquidity in the U.S. economy. As a result, consumers spend more, resulting in larger corporate sales and profits, and eventually, a bull market. Low rates for an extended period of time, on the other hand, can be a dangerous indicator because they can't endure forever. Debt will have to slow and rates will have to rise at some time, causing consumer spending to tighten and, if the contraction is large, a stock market crash. Another method the Fed stimulates the economy is through purchasing bonds. The Fed exchanges liquid currency today for bonds with future maturity dates by purchasing large amounts of bonds. This fills the market with spendable cash, encouraging the same reckless spending that low interest rates frequently encourage. Fearful investors wonder when the bears will take over, and the market will crash whenever there is a bull market. It's understandable that as prices reach new highs, many investors are asking when the next crash would occur. The good news is that market losses don't last forever, and even in the face of a market crash, prudent investment decisions can lead to gains, which is why doing your homework before investing is so crucial. Like and subscribe to our channel for more informative videos, share with your friends as well. Engage us on the comment section, and turn on the notification bell to be notified when a new video is uploaded. Thank you for watching.